In 2000, China barely existed in Africa. There were no Chinese ports, no Chinese roads, no Chinese stadiums. There were no 150,000 Chinese companies on the continent. There were no Chinese military bases. There were no debts to Beijing worth hundreds of billions of dollars. 25 years passed. Today, China is Africa's largest trading partner and largest creditor, the largest builder of infrastructure. In more than 30 African countries, projects financed by Chinese state banks are operating. Ports, railways, airports, telecommunication networks, power plants. All of this has been built, financed, or is managed by structures connected to Beijing. No one fired a shot, no one sent in troops, no one toppled governments. This is not a takeover in the conventional sense, it is smarter, and that is precisely why it works. Today, we break down how China over 25 years became indispensable to an entire continent, not through force, through an offer that is impossible to refuse. To understand why China entered Africa so easily, you first need to understand what came before it. From the 90s, the main source of financing for African countries was two institutions: the International Monetary Fund and the World Bank. Both are based in Washington and are run predominantly by Western countries, and both gave money, but with conditions. The conditions had beautiful names: structural reforms, adjustment programs, macroeconomic stabilization. In practice, this meant cut government spending, privatize state companies, open the market to foreign goods, remove subsidies on food and fuel. For countries with young economies, weak institutions, and high poverty, these conditions often meant one thing: the government that implemented them lost the next election. Because people did not see macroeconomic stabilization. They saw that bread had become more expensive, fuel subsidies had disappeared, and the state factory had been bought by a foreign investor who fired half the workers. Western money came with political conditions. Democracy of a certain format was required. Transparency of a certain standard was required. Human rights of a certain level were required. This is not necessarily bad in itself, but for the president of an African country who needs a stadiums before elections 8 months away, or a port to export copper, or a road to connect the north and south of the country, Western conditions meant years of negotiations, audits, approvals, and political concessions. And the money might still not come. And it was at this moment that China appeared. The Chinese offer sounded fundamentally different. No conditions on political structure. No human rights requirements. No structural reforms. Just business. We build you infrastructure, you pay with resources or future revenues, fast, without bureaucracy. For African leaders, this was convenient. The first major signal was the Forum on China-Africa Cooperation, FOCC, which was held for the first time in Beijing in 2000. China invited the leaders of African countries, announced a package of financial assistance and debt cancellation for the poorest countries on the continent. This was not a humanitarian action. This was a bid for a relationship. Since then, FOCAC has been held every 3 years, each time China announces a new package, larger than the previous one. This worked and continues to work to this day. China has 3 main instruments in Africa: infrastructure, debt, people. They work together, and it is precisely their combination that makes China's presence on the continent so resilient. Let's start with infrastructure, because that is what is visible. China builds in Africa what no one else builds: roads in hard-to-reach regions, railways between countries that were previously unconnected, ports in countries that previously depended on neighbors for exports, stadiums, presidential palaces, government buildings, universities. Chinese state banks, primarily the Export-Import Bank of China and the China Development Bank, issue loans for infrastructure projects on terms that look attractive at the outset. Interest rates are generally below market rates. Repayment periods are long. The grace period without payments can be several years, but there are details in the contracts that are rarely discussed. First detail: most Chinese infrastructure loans require that construction be carried out by a Chinese company. This means that the money China gives as a loan largely returns to China in the form of contracts for Chinese construction companies. The African country gets infrastructure and debt. The Chinese company gets the contract and the profit. Second detail. Contracts are often classified. The AidData Research Lab at Williams College studied hundreds of Chinese loan agreements with developing countries and found standard clauses that prohibit the borrowing country from disclosing the terms of the loan even to other creditors. This means that when the IMF or World Bank try to assess a country's debt burden, they do not know the real terms of the Chinese loans. Third detail, and this is the most important, collateral assets. In a number of contracts, the collateral for the loan is not simply the country's future revenues, but specific assets. Ports, deposits, stakes in state companies. If the country cannot service the debt, China has the right to those assets. Now the second instrument, people. Along with Chinese loans and Chinese construction companies, Chinese workers come to Africa. By various estimates, by the mid-2010s, between 1 and 2 million Chinese citizens were working in Africa. Some of them are temporary workers on construction sites. Some are managers and engineers. But a significant portion are entrepreneurs who stay after the projects are completed. In Zambia, Angola, Ethiopia, Kenya, Chinese quarters have grown up. Chinese markets where Chinese goods are sold cheaper than local equivalents. Chinese restaurants, Chinese banks, Chinese telecommunications companies. Huawei built telecommunications infrastructure in most African countries. ZTE built government communications networks. The third instrument, resources. Africa is not simply a sales market for Chinese goods. It is the raw material base for Chinese industry. Oil from Angola, Sudan, Nigeria. Copper and cobalt from Zambia and Congo. Iron ore from Guinea. Rare earth metals from dozens of countries. This is precisely why China builds roads and ports in places that seem economically impractical. A road to a remote region of Ethiopia does not pay for itself on its own, but if at the end of that road there is a deposit that needs to be exported, the picture changes. A port in a small country on the coast of the Indian Ocean is not needed by the local economy. But if Chinese exports and resource imports flow through that port, it is needed by China. The infrastructure is not being built for Africa. The infrastructure is being built for the supply chains that China needs. Now about what happens when the money runs out, because it is precisely here that you understand how the whole system works. 2017 Sri Lanka. This is not Africa, but this is where something happened that changed the conversation about Chinese loans around the world. Sri Lanka took Chinese loans to build the port of Hambantota in the south of the country. The port was built in the hometown of then-President Mahinda Rajapaksa, which in itself already speaks to the logic of decision-making. The port turned out to be unprofitable. Very little cargo passed through it, because it was located away from the main trade routes. The debt accumulated. Servicing it became increasingly difficult. In 2017, Sri Lanka concluded an agreement with the Chinese state company, China Merchants Port Holdings. 70% of the port's shares would pass to the Chinese company for management for 99 years in exchange for writing off part of the debt. Back to Africa. Zambia, a country with enormous copper reserves, one of the poorest in the world. In the 2010s, Zambia was actively taking Chinese loans for infrastructure, roads, airports, energy. By the end of the decade, debt to Chinese creditors accounted for a significant portion of the country's external debt. In 2020, Zambia became the first African country to default on its Eurobonds during the pandemic. Debt restructuring negotiations dragged on for years, in part because Chinese creditors and Western bondholders could not agree among themselves on who should write off how much. During the negotiations, details of the Chinese contracts surfaced. It emerged that a number of contracts contained conditions giving Chinese creditors priority over other creditors in payments. That is, if Zambia has money to partially service its debt, it pays China first, then everyone else. But the most interesting thing in the Zambian story is the copper. Chinese companies control a significant portion of Zambia's copper industry. CNMC, China Non-Ferrous Metal Mining Group, is one of the largest operators of copper mines in the country. The copper is mined, exported, processed in China. Zambia receives royalties and taxes, but the core value is not created here. Ethiopia, the largest country in Africa by population, one of the fastest growing markets on the continent in the 2010s. China invested enormous money in Ethiopia. A railway from Addis Ababa to Djibouti, industrial parks, telecommunications, energy. The railway, 752 kilometers long, became a symbol of China-Africa partnership. It was built by two Chinese companies, financed by the Export-Import Bank of China. Most of the workers on the construction were Chinese. It opened in 2017. By 2018, it emerged that the railway was unprofitable. Freight traffic was significantly below forecasts. Ethiopia could not service the debt to the Export-Import Bank. Restructuring had to be negotiated. At the same time, Ethiopia kept the railway. This is important. No one took it away. But the debt went nowhere. It simply stretched out over time. And management of the railway for the first few years after opening was carried out by Chinese companies, because the Ethiopian side lacked the technical competencies. By 2023, African countries collectively owed Chinese creditors around $170 billion. China has built or financed more than 1,000 infrastructure projects in Africa over the past 20 years. Roads that people drive on, ports that goods pass through, power plants that provide electricity, stadiums where people play football. This changed the lives of millions of people for the better. And at the same time, resources flow to China, debts accumulate, contracts are classified. Chinese workers and entrepreneurs settle on the continent. Telecommunications infrastructure is built on Chinese equipment. Government buildings, also of Chinese construction, with Chinese security systems. In 2021, Uganda found itself in a situation where a loan agreement with the Export-Import Bank of China for the construction of an airport contained a clause by which, in the event of default, China would have the right to control the country's only international airport, Entebbe. When the Financial Times wrote about this, the Ugandan government was forced to negotiate a revision of the terms. To call this colonialism is to oversimplify. Colonialism operated through direct violence and political control. China does not do this. African governments signed contracts voluntarily. No one held a gun to the head of the Zambian president when he took the loan. But to call this simply business is also to oversimplify. Because when a creditor knows that the borrower will not be able to repay the debt and writes into the contract the right to a strategic asset, this is not simply business. This is strategy. And Africa, a continent with 1,400 million people, the youngest demographics in the world and resources, without which not a single green energy system on the planet will function, finds itself at the center of this game. The difference is that today, African countries have a choice between several major players. The question is whether that choice is enough for the outcome to be different.